Debt consolidation explained. Before the coronavirus pandemic, financial advisors typically recommended people prioritize debt payoff first and foremost. But following a spike in unemployment and now rising inflation, the focus has shifted to savings. It is very important to have an emergency savings account. And while experts advise you stash anywhere from 3 to 6 months worth of expenses in a high-yield savings account, having at least a $1,000 saved is a good place to start. But it's hard to know what goals to prioritize if you've got a lot of credit card debt and not much savings. As long as you make your minimum payments on time, your credit score will stay in okay shape, and saving will help you be prepared for financial surprises ahead, such as getting laid off, losing revenue, or being furloughed. However, credit cards have the highest interest rates out of every kind of credit product. If you've recently decided to stop prioritizing paying off your lingering credit card balances so that you can pad your nest egg instead, you may end up paying a staggering amount in interest in the long run. One solution is to use a personal loan through companies like Sophie, Lightstream, or Happy Money to consolidate your credit card debt into one monthly payment. This usually results in lower interest and can help you interrupt the debt cycle for good. Debt consolidation refers to taking out a new loan or credit card to pay off other existing loans or credit cards. By combining multiple debts into a single, larger loan, you may also be able to obtain more favorable payoff terms, such as a lower interest rate, lower monthly payments, or both. Here's how to decide whether you should consolidate your debts and how to go about it if you do. How debt consolidation works. You can roll old debt into new debt in several different ways, such as by taking out a new personal loan, a new credit card with a high enough credit limit, or a home equity loan. Then, you pay off your smaller loans with the new one. If you are using a new credit card to consolidate other credit card debt, for example, you can transfer the balances on your old cards to your new one. Some balance transfer credit cards even offer incentives, such as a 0% interest rate on your balance for a period of time. In addition to the possibility of lower interest rates and smaller monthly payments, debt consolidation can be a way to simplify your financial life, with fewer bills to pay each month and fewer due dates to worry about. An example of debt consolidation. Suppose you have 3 credit cards and owe a total of $20,000 on them, with a 22.99% average annual interest rate. You would need to pay about $1,047 a month for 24 months to bring the balances down to zero, and you'd pay about $4,603 in interest during that time. If you consolidated those credit cards into a lower interest card or loan at an 11% annual rate, you would need to pay about $932 a month for the same 24 months to erase the debt, and your interest charges would total about $2,157. Risks of debt consolidation. Debt consolidation also has some downsides to consider. For one, when you take out a new loan, your credit score could suffer a minor hit, which could affect whether you qualify for other new loans. Depending on how you consolidate your loans, you could also risk paying more in total interest. For example, if you take out a new loan with lower monthly payments but a longer repayment term, you may end up paying more in total interest over time. Types of debt consolidation loans. You can consolidate debt by using different types of loans or credit cards. Which will be best for you will depend on the terms and types of your current loans and your current financial situation. There are 2 broad types of debt consolidation loans: secured and unsecured loans. Secured loans are backed by an asset like your home, which serves as collateral for the loan. Unsecured loans, on the other hand, are not backed by assets and can be more difficult to get. They also tend to have higher interest rates and lower qualifying amounts. With either type of loan, interest rates are still typically lower than the rates charged on credit cards. And in most cases, the rates are fixed, so they won't rise over the repayment period. With any type of loan, you'll want to prioritize which of your debts to pay off first. It often makes sense to start with the highest interest debt and work your way down the list. Here are a few more details about the most common ways to consolidate your debt. Personal loans. A personal loan is an unsecured loan from a bank or credit union that provides a lump sum payment you can use for any purpose. You repay the loan with regular monthly payments for a set period of time and with a set interest rate. Personal loans generally have lower interest rates than credit cards, so they can be ideal for consolidating credit card debt. Credit cards. A new card can help you reduce your credit card debt burden if it offers a lower interest rate. As mentioned earlier, Some credit cards offer an introductory period with 0% APR when you transfer your existing balances to them. These promotional periods often last from 6 to 21 months or so, after which the interest rate can shoot up into double digits. So it's best to pay off your balance, or as much of it as you can, as soon as possible. Note that these cards may also impose an initial fee, often equal to 3% to 5% of the amount you are transferring. Home equity loans. If you are a homeowner who has built up equity over the years, a home equity loan or home equity line of credit, HELOC, can be a useful way to consolidate debt. These secured loans use your equity as collateral and typically offer interest rates slightly above average mortgage rates, which are generally well below credit card interest rates. Debt consolidation and your credit score. A consolidation loan may help your credit score in the long term. By reducing your monthly payments, you should be able to pay the loan off sooner and reduce your credit utilization ratio. This, in turn, can help boost your credit score, making you more likely to get approved by creditors and for better rates. However, rolling over existing loans into a brand new one may initially have a negative impact on your credit score. That's because credit scores favor older debts with longer, more consistent payment histories. Qualifying for debt consolidation. Borrowers must meet the lender's income and creditworthiness standards to qualify for a new loan. For example, for a debt consolidation loan, you may need to provide a letter of employment, 2 months' worth of statements for each credit card or loan you wish to pay off. Does debt consolidation hurt your credit score? Debt consolidation could temporarily affect your credit score negatively because of a credit inquiry, but it can help your credit score in the long term if you use it correctly. Most people who make their new payments on time find their credit score increases significantly as they avoid missing payments and decrease their credit utilization ratio. What are the risks of debt consolidation? Consolidating debt could potentially lead to you paying more in the long run, particularly if you consolidate credit card debt but then continue to use the cards you paid off. There may also be a minor, short-term ding to your credit score. What is the best way to consolidate debt? The best way to consolidate your debt will depend on the amount you need to pay off, your ability to repay it, and whether you qualify for a relatively inexpensive loan or credit card. Fortunately, you have a number of options. What is debt settlement? Not to be confused with debt consolidation, debt settlement aims to reduce a consumer's financial obligations rather than the number of creditors they have. Consumers can work with debt relief organizations or credit counseling services to settle their debts. These organizations do not make actual loans but try to renegotiate the borrower's current debts with creditors. If you find this video useful, don't forget to like and subscribe to our channel.